Hey guys, I'm back with another video this week, and today I'm going to be breaking down why it is so important to be buying in the right area and know where to look if you want to build a property portfolio quickly. And just a side note, I didn't dress up for the video as much as you might like to think. I do work as an associate broker, so that means I work 4 days from home. Here's the office, and 1 day in the city. So today was my city day, and this is what I wore. When it comes to buying property as an investment, everyone knows that if you hold property over the long term, you're likely to do well. And by long term, I mean holding property over decades. Like any investment, when it comes to compound interest, the longer you hold that asset, the better your return is going to be. And the majority of your return will actually occur in the later years of holding that asset. Over the last 30 years, according to CoreLogic, the average return of the Australian property market has been 6.8% per annum. Now, this doesn't mean that property goes up by 6.8% year on year on year. Property works in cycles, so there's always going to be ups, downs, and flat periods. Now, this is just the average. So during that time period, there would have been properties that have done better than the 6.8% average, and there would have been properties that have done worse. To try and beat the average, you need to be educated and you need to know where to look. It's a risky game if you just throw a dart and buy any property at any price whenever you decide to, because you run the risk of buying the wrong property at the wrong time and essentially losing money. And not just lose money, you may actually make a little bit of money, but you may lose the opportunity to make more money. This is known as the opportunity cost. I hear time and time again that Sydney is king and Brisbane's coming because it is now the second most expensive capital city here in Australia. But as I said earlier, property does work in cycles, so there are always ups, downs, and flat periods. And these two markets are absolutely no different. Between 2004 and 2014, the Sydney market only grew by 24%, which is 2.4% per annum for that decade. But if you were uneducated and you didn't know how to research a property and you bought in 2004, you would be pretty pissed off in 2014 when your property's only grown by 24%. This is a similar story for Brisbane, which has been one of the hottest markets here in Australia over the last 5 years. But many people don't realise that Brisbane also had a really flat period prior to this boom. Between 2009 and 2019, the Brisbane market only grew by 24% according to CoreLogic, same as Sydney at 2.4% per annum for that decade. So if you bought in 2009, that would have been a bloody long decade holding that property and only getting 2.4% a year. But this is exactly why we hold property for the long term, because over the next 5 years, all of those investors would be bloody happy that they had a property in Brisbane, because it's been one of the hottest markets by far in Australia during that period. In this video, I'm going to break down exactly what the Australian property market has done over the last decade. So there's intervals of 3, 7, and 10-year returns that I'm going to be talking about. Let's start in my home city, which is Melbourne. Over the last 3 years, Melbourne has returned a measly 3.9% per annum. This is well below the average, and there are many factors as to why it's had such a crappy return the last 3 years. Unless you've been living under a rock, you'll be well aware that we had all of those consecutive rate rises about a year ago, and this has had a really large impact on the Melbourne market especially. It's not only the rate rises that have hurt Melbourne, land taxes also increase, and this has really hurt investors. Melbourne, in comparison to the other capital cities, also has a higher level of stock on market, which supply and demand says is not going to help grow prices or grow rent, and that's been evident in the lack of price growth. Over the last 7 years, it's been a similar story, and Melbourne has returned 3.7% per annum, an even worse result than the last 3 years. And the last period I'll talk about for Melbourne is the 10-year period, and in that time, Melbourne has returned 6.2% per annum. So a lot closer to the average return of the Australian property market, which is 6.8%. This just goes to show, as I said earlier, there are always going to be ups and downs and flat periods within a market, but over the long term, the trend is typically positive. To give you a clearer picture of what these numbers actually look like in real terms, let's say that you were purchasing a $500,000 investment property. If you purchased this property in Melbourne 3 years ago, it would now be worth approximately $560,000. And some may say, that's great, I've just made $60,000 by owning this property. But the thing is, with the Melbourne and Sydney markets, it's likely got a very low yield when compared to other capital cities. So this property is likely being very negatively geared, and also it's only had a little bit of growth. So that $60,000, a lot of that profit would be eaten up in costs. And as you'll see as this video progresses, you'll see some of the opportunity cost of what would have happened if you had bought elsewhere. If you bought this $500,000 property in Melbourne 7 years ago, today it would be worth $623,000. At the 10-year mark, you'll see that Melbourne does redeem itself. So if you purchase a $500,000 property 10 years ago, it would now be worth around $912,000 in today's market. This is why it is so important to zoom out and look long term when you're holding investment properties, and don't buy into the ups, downs, and flat periods in the short term. Don't get me wrong though, the short term is extremely important if you want to build a portfolio quick, because you'll need that growth to get into the next property. Next up, we're hopping on the Spirit of Tasmania and we're heading down to Hobart. Over the last 3 years, Hobart has returned 6.2% per annum. Over the 7-year period, this increases to 7.8% per annum because during this time, Hobart had a really good run. And over the 10-year time frame, Hobart returned 7.3% per annum. Again, a really solid return over the 10 years. Using the same example as before with the $500,000 property, if you bought this $500,000 property in Hobart 3 years ago, today it would be worth $598,000. If you bought this $500,000 property in Hobart 7 years ago, today it would be worth around $846,000, which is a return of $346,000 in 7 years. And after a really solid decade in Hobart, if you bought this $500,000 property 10 years ago, today it would be worth over $1.01 million, meaning that it has doubled in the last decade. A great result. The next market is one of the most popular here in Australia, and it is Sydney. And Sydney is king according to many investors. Over the last 3 years, the average return in Sydney has been 6.2%, which isn't too bad, especially when compared to Melbourne, when historically those two have always been somewhat linked and compared to each other. Over the last 7 years, you'll actually see that Sydney has returned 4.4% per annum, which is a pretty average result for some place that people call king. In the 10-year time frame, it does increase back up to 6% per annum, which is much closer to the 6.8% average figure of the Australian property market over the last 30 years. Same as Hobart, if you purchase a $500,000 3 years ago in Sydney, it would be worth $598,000 today. If you purchased this same property 7 years ago, it would be worth $675,000 today, which was a pretty underwhelming period for the Sydney market. And after a decade of growth, that property in Sydney would be worth $895,000, much closer to the average. And this is where it starts to get interesting because we're going to talk about the hottest market currently in Australia. Over the last 12 months, the Perth market has returned around 24.7% according to CoreLogic, which has been a bloody crazy return, and having properties in this market, it's also been a really nice ride. Over the last 3 years, the Perth property market has returned 13.8% per annum, which is around double the average return of the Australian property market over the last 30 years. This figure more than halves when you get to the 7-year time frame, meaning that it goes down to 6.3% per annum. And it gets even worse because over the last 10 years in Perth, the average return has been 3% per annum, which is only 30% of growth over the last 10 years, and mainly due to Perth having a really crap run for 10 years between 2010 and 2020. If you purchased that $500K property in Perth 3 years ago, today it would be worth $736,000. $236,000 worth of growth in 3 years, that sounds pretty good to me. And that's just the average, so that means there have been properties that have returned better than that, and obviously ones that have done worse, but if you're educated enough, you should be able to beat the average. This is where it starts getting interesting. If you bought that $500,000 property in Perth 7 years ago, it would only be worth $766,000. And if you purchase a property in Perth 10 years ago, today it would only be worth $671,000. As I said earlier, this is due to a really bad run for Perth the 10 years prior to 2020. Now, this may not make sense to you. How can you own a property for 10 years and somehow make less than a person that's only owned it for 3? So this meant that the $500,000 property that you originally purchased 10 years ago in Perth dropped in value, and then you got the return, but you're starting at a lower base point, hence why you're behind someone who bought 3 years ago starting in Perth. Next, we're going to head to Bris Vegas and see what it's done over the last decade. Brisbane has been one of the hottest markets in recent period as well, and over the last 3 years, it has returned a whopping 16.5% per annum, which is over 50% of growth for the average property in Brisbane over the last 3 years. Over the last 7 years, it has also been very strong at 9% per annum. And over the last 10 years, it's had a very commendable 7.4% per annum, which is above the average. A $500K property in Perth 3 years ago would be worth $785,000 today, which is $285,000 of growth in 3 years. Bloody crazy. If you bought that property 7 years ago, today it would be worth $914,000, which has almost doubled in 7 years. And if you purchased that property 10 years ago, that property would be worth $1.02 million after the decade. Another city that has doubled in the last 10 years. And last but not least, we have the City of Churches, Adelaide. Adelaide has had the highest return over the last 3 years, averaging a whopping 16.7% per annum for the average property there in Adelaide. It's a similar story for the 7-year period where it has returned a commendable 8.8%, which is a great return. And over the decade, it has returned 6.5%, which is slightly under the average return of 6.8%. If you purchased that $500,000 property 3 years ago, today it would be worth $795,000, which is $295,000 of growth in 3 years on a $500K investment. If you purchased that property 7 years ago, it would be worth $902,000, almost doubling in the 7-year period. And if you purchased that property 10 years ago in Adelaide, today it would be worth $938,000, which is still a really solid return. But Adelaide had a bit of a quieter run in the early part of this decade, and the last part of the decade has gone absolutely mental, hence why it's got such a good return recently. Now, the last 3 markets that I mentioned, Perth, Brisbane, and Adelaide, are still all firing. All of these places have a chronic shortage of houses at the moment, meaning that there's plenty of demand, but the supply year on year is decreasing, meaning that there's less and less stock available for people to purchase and rent, which ultimately results in rental growth and capital growth, which all of these markets have seen plenty of recently. So the point of this video is to show that if you do want to build your portfolio quickly, you're gonna need to see growth in the short term. This is because it takes a bloody long time to save a deposit to get into your next property, whereas if you use some of the equity growth, you can get into that one sooner and propel your portfolio using leverage and building that asset base. I hope this video shows you that property does really work in cycles. So even though Perth, Brisbane, and Adelaide are all experiencing their time in the sun, 10 years from now, they might have a flat period. And at the other end of the spectrum, we've got Melbourne, who has been really cold of late, but that doesn't mean it'll stay cold forever. If you ask me, Melbourne is quite undervalued, so it's a market I'm definitely keeping my eye on. If you have any other videos that you want me to make specifically, leave a comment below and I'll add it to my list of videos that I need to make. But if you don't leave a comment, I won't know to make it. See you next video.